Canada's credit boom is quietly running out of runway. If we go back over 50 years to 1973, household credit was growing at 21% a year. Today, it's growing at 4.4%. To put that in perspective, that's a 50-year structural story, but it seldom gets much attention. Over that time frame, each peak has come in lower than the last. In 1987, it was 17%. In 2007, it was 13%. In 2022, it was 7.7%. As of the beginning of this year, it stood at 4.4%. And in every cycle, Canadians borrow a little less aggressively than the previous one. Canadian borrowers are tapped out, it seems. If we zoom in on those numbers, the 3-month rate of change, which shows what the credit is actually doing, now sits at under 1%. The same is true for mortgages, just over 1% on a 3-month basis. The Bank of Canada cut rates multiple times last year and the year before, but Canadians didn't rush back to borrow. It seems they're tapped out. When debt is the engine of economic growth and it starts sputtering, it's important to pay attention. Declining credit velocity is something that is frequently overlooked. Each lower high means the next stimulus cycle has less debt capacity, which is why Canada's housing policy keeps needing bigger interventions just to produce smaller results. Credit has expanded massively, and now that the war in the Middle East looks to be persisting and expanding, inflation is a growing concern. Well, that's the story in Canada. In America, as of the beginning of spring, the market now expects a 50% chance of the American Central Bank, which is the Federal Reserve, to increase interest rates in 2026. Until recently, the market was anticipating 2 to 4 rate cuts. Gas prices are now up nearly 50%. And if oil prices remain this high in April and May, it's expected that inflation in the US will exceed 3%. It looks as though we're back into a monetary environment like 2022, where rates were higher for longer. Meanwhile, the accumulated debt in the US has just surpassed $39 trillion. Debt has been out of control for a while now, but now that rates are climbing, that spiral will only accelerate. Jerome Powell cannot print crude oil. Christine Lagarde cannot secure international shipping lanes. Tiff Macklem can't stop geopolitical aggression from expanding. Monetary policy simply doesn't work when faced with a military conflict. Central banks can threaten to hike rates to try to keep things stable, but they can't do a darn thing to repair fractured supply chains. You can't lower rates to boost the economy while experiencing a massive inflationary shock.